Boom. All right. It looks like it's recording. Welcome, everyone. So I'm going to dive right in because I probably recorded an intro in advance to the podcast. I've got with me today Dave Hendricks from Vertalo, Justin Newton from Netki, and Marty Tate from your firm has been renamed, right? Carman. Tell me what it is, Marty. And you can start with the introduction. You're muted. You're muted, Marty.
There we go. Perfect. Can you hear me now?
All right.
Yep. Yeah. So it's a test, Alon. I just want to see if people can pronounce it. So it's Carman Lehnhof, Tate Israelsen, but we just go by Carman Lehnhof. We're rebranding a little bit now. So yeah, there you go. Would you like an introduction? Did you say?
Yes.
Okay. Yeah. So I am a securities lawyer. I've been practicing about 20 years. Was very active in the crowdfunding space. That's actually where I met Alon years ago, and have worked with platforms, issuers, service providers, you name it. And by sort of luck, chance, providence, got into the crypto space. A few years ago was at one of Alon's maybe his first summit, and that there was a lot of buzz about crypto, and there were some of us service providers that were saying, I don't know about this stuff, and talking amongst ourselves saying, well, we'll see how long this lasts. And little did I know that a year later it would be 95% of my practice. So that's where we're at.
Cool. Justin, give me a little background.
Sure. Hey, I'm Justin. I'm the co-founder and CEO over at Netki. Netki, we started about 5 years ago, and we focused really on what are the needs and requirements of the crypto ecosystem, and have spent much of that time working in compliance, primarily like KYC, AML, accredited investor validation, all of those customer onboarding pieces that you need to do, kind of across the public blockchain ecosystem and beyond. And, our experience in this space, literally predates ICOs. And we work broadly with participants all across the ecosystem, including issuing platforms, direct issuers themselves, exchanges, crowdfunding platforms, et cetera. And so we've gotten to touch a lot of different pieces across the ecosystem and really watch it evolve over time as well.
Awesome. And Dave, let's get your background.
Hey, Alon. Hey, Justin. Hey, Marty. Great to see you guys today. So Vertalo started in 2016, and me and my two partners, one's a PhD in math, that's William Bagster, and the other one's a former SEC attorney and securities lawyer named Gautam Gujral. We started looking at doing an ICO in September of 2017. But quickly, in conjunction with our lawyers, we decided that an ICO wasn't a great way to go for us because we didn't want to violate any securities laws. So in October of 2017, Vertalo started working on what ended up being one of the first security token issuances. And we issued our own security token in March of 2018 to 52 holders. Well, in the process of doing that, we were taking a look around the market and trying to find the tools that we needed to run our own investor relations and our cap table. And we found out that, wow, there were no actual cap table tools for security tokens. Yeah, I'm a former corporate secretary and CFO, and I'm kind of used to these kinds of things like, hey, everything needs to add up to 100%, and everyone needs to know what they own and who else is an owner and what the terms are. And so we decided to actually shelve our other project that we had issued the security token for and just focus purely on compliant investor onboarding and then cap tables, so that any issuers or broker dealers that were doing originations or offerings would have a place to take and put their security token holders on. But of course, we wanted to do it on the blockchain. So we create a blockchain-enabled on-chain cap table that connects to sources of secondary liquidity. So we said, oh, look, if you're going to be a cap table for blockchain-based securities, well, you better be on the chain too. So that's what we did. And so now, similar to Justin and Netki, we serve direct issuers, but we also serve broker dealers, and we can white label our platform so a broker dealer can use it for investor onboarding and cap tables. And this is just stuff that we think is boring stuff which everyone needs. And so we solved a problem that we had ourselves, and that's how we created our company.
Cool. So my main thought when I got this crew together was that we have a lot of the pieces here and the expertise to discuss not just getting started, but doing issuing a security token or raising money for your company and doing it right, doing it compliantly. And we're not, aside from me, we're not talking about the marketing side of things. We're talking more about the official doing things right side of things. So that's where I wanted to kind of start, and the a good theme that Dave sort of mentioned is sort of changing the way we look at issuing a security token from the beginning, or changing the way the approach for launching a security token. But before we actually go there, I have a couple quick questions on both Justin and Dave's side about your companies, real quick. So Dave, actually, so when you talk about the cap table side of things, you talk about being on chain. Let me pause something that's making some noise on my laptop. You discussed, things being on chain, and you discussed things adding up to 100. So part of the beauty of doing tokenizing things are that technically it should all be transparent. It should all be math related, and it should, and I say, be relatively easy to calculate these things, no? So what are the sort of pitfalls when it comes to a cap table for a tokenized asset? Is there different classes of shares? I mean, I'm sort of inching my way in answering the question, but is there different classes of shares? Is there different, waterfall scenarios? Is there different just,
yes.
How does it work? What makes that important in this world where some people would say, like, that's the whole point. You don't need a cap table.
Well, it's, if you're doing an equity investment in something, you definitely need a cap table, or a partnership or something like that. I think that if all your parts add up to more than 100%, you're probably in trouble in an equity or a partnership relationship. So first of all, just because you're on chain doesn't mean that you can't have different tranches or different shares or classes. You can have equity options, you can have preferred shares, you can have common shares. Our system accommodates all of those different kinds of classes. The key thing is actually that you provably own them. Imagine you're an employee in a startup. When you sign up for onto that company, they say, oh yeah, you're going to get a bunch of options, etc. And you sign this document thinking, oh, I'm going to be a thousandaire eventually, when the company it goes public. Well, the problem is that they take that piece of paper and they take it to a board meeting, and it gets in some resolutions, and eventually it turns into a stock option document which sits in a file drawer somewhere. But the entire time you're an employee of that company, you have no proof that you actually have those options. They're actually hidden in a cap table in a centralized database somewhere, and so you don't actually even see them. The same thing goes for preferred shareholders. Every time you do a fundraise, you'll issue maybe a consent or something, but you actually don't see it in a wallet, okay? You have a representation on paper. But what if, as you went through all the different tranches of a fundraise, or as your options vested, et cetera, that they actually transfer to your wallet, okay? And that they're that much closer to you, and you could actually have possession for them. Now imagine that as those shares matured and they vested and they became exercisable, that your wallet was connected to an exchange like Open Finance or T0, and that you might actually have the option to sell them and trade them all based on governance to a
And
third.
yeah, I was going to say, and I'm assuming that because it's a token, you can even in those tokens, depending on who owns them, have certain restrictions or compliance features.
Yeah. So to us, the reason why cap table on chain is one, provable. Okay. So you can see that you own it. You have a contract between the investor, the employer, the founder, and the issuer. You've got, it's not dematerialized. You actually see the smart contract in your wallet. And then you're one step closer to secondary liquidity, which is the biggest problem in early stage companies right now. The goalposts keep on moving further out. And it's very, very expensive to try to do a secondary sale on off a paper-based cap table. It just requires too much work. So what if you could build that in? That's the mission that I'm about.
I love it. So my thoughts are, just to kind of respond to that, is how do you, as an investor or as an employee, go one step beyond and even verify what tranche you're in, what rights you actually have, and are any of those things in the token, or is that more like, oh, now I have to do my own due diligence and contact the lawyers and go like, well, they raised a Series A with these people out of way preferred shares, you're getting these kind of shares, you're getting options, whatever, they have to sell the company for $100 million to just pay back those previous investors before you get a cent. Is there anything there to protect investors, or is there, anything other than doing just due diligence that can fix that? Is there?
Before I hand the mic over to Marty, who I know has a lot of opinions about this, and I'm hoping that we agree. I don't think that today, at this point, that's practicable to load up a 50-page PPM or stock purchase agreement and all the ROFRs and all the governance into a token. I think that may come in the future, and I'm hoping that there's a time when you can load some of that up, but we're not there yet. So I believe that a lot of that is referred to off-chain. But what you do is, using the transfer and operating parameters in a smart contract, and Rule 144 and 12G and all these other things, you can program some of that simpler stuff in today. There are going to be some.
I think I mostly asked it as a loaded question, because when you sign up to be an employee at a company and you get options or whatever, nobody knows or really fully accounts for the fact that there are those other, VC investors in the company that might have liquidation preferences and things like that. You just think, oh, if they sell for $100 million and I own 1% of the company, I'm going to get $1 million. It's never how it actually works.
People don't know about participating, like 2x participating preferred.
All these weird VC terms. Marty, is there something from a legal side people can know or do or ask to get sort of some of that transparency?
Well, I think that Dave, I do agree with you that that perhaps someday that we'll be able to, like you said, load up all of that information and on a token. I'm I'm hesitant to rush there, though. I think that there has to be some of that stuff that's strictly done, off chain, like Dave said. I think that a lot of the rights associated with, maybe not all of the rights associated with that token can be built into the smart contract if there are right of first refusals, or if there are these parameters regarding transfers, regarding the voting rights, whatever it is. I think that blockchain actually provides an optimal solution. And what Dave and Vertalo are doing is right there on the cutting edge of what I think we're going to see. And I've been a big proponent for this for several years, about really, we're not changing the law, we're modernizing it. And I think the blockchain allows sort of the modernization and the facilitation of a lot of things that are already there. I mean, like you said, if you have a smart contract that has Rule 144 and 12G rules built in, as far in any other lockup periods or restrictions on transfer, you can build all of that into the smart contract, and it actually provides greater transparency. a lot of what we, maybe it's taking work away from lawyers, but, I write a lot of Rule 144 opinions, and, and then that requires us to go back and look at corporate documents and look at their filings and so forth. Whereas I think that, here in the not so distant future, all of that's going to be built in, so that once those parameters are made, the smart contract will just automatically allow that to happen. I don't, it remains to be seen how a lawyer's opinion will weigh into that. And maybe it's at the front end that says the opinion's there and says, yeah, once all of these things are met, then Rule 144 applies.
Cool. So going along the lines of the automating certain things and making things, if not cutting out the lawyers, streamlining the process, right? That's I think obviously where Netki comes in, regardless of if a deal or something is on the blockchain.
Can we do one thing first though, Alon? Can we maybe have Marty explain Rule 144, because we just went into geek territory. So let's de-geek
probably
first.
a good idea.
Yeah,
Marty, what's Rule 144?
Rule 144, and that's about the simplest part of it is just saying its name, because it's actually a really complex rule. It applies to the private transfer of securities, and it requires that certain conditions be met before the restrictions. And thanks a lot, Dave, for introducing this. So most of the securities that are issued are going to be restricted securities if they're done under a private placement under Reg D or another exemption. They're going to be restricted securities, which means you can't go and sell those securities or publicly sell those securities. So Rule 144 is a safe harbor that it says that if certain conditions are met, then the restrictions can be removed. And the ones that people tend to focus on are generally the holding period. How long has it been held? And it kind of depends. The holding period is 6 months or 12 months, depending on if you are an insider of the company or affiliate or a control person. There's other requirements, including informational requirements. If it's a publicly traded company, if they've been making all of their public filings with the SEC. And so that's the basic rule. And so that's what I'm saying. And so a 144 opinion is somebody will come and say a transfer agent will require the person that holds restricted stock to get an opinion from a lawyer that says Rule 144 has been met. And so backing up to that.
And Rule 144 lays these things out. So no matter what restrictions are in the docs of the deal, once Rule 144 is met, those restrictions get thrown out the window, or is it certain restrictions? How does it exactly?
So restrictions on transfer. So it basically saying you can't, and it generally has to do with the type of sale too. Rule 144, we talk about it a lot in this with respect to private stock, but it really, you see it being more relevant with publicly traded, with public stock reporting company that's sold in a private placement. They want to go, it's listed on the OTC. They want to be able to go and liquidate some of it through a broker dealer. They'll require that opinion. With respect to, but we're seeing it's definitely a word that gets used a lot and thrown around a lot when we talk about security tokens, and we talk about these things about the liquidity of those, because you opened it up, liquidity. So we hear that is a possible way to trade these tokens that, if you bought in a token offering, or you participate in a securitized token offering, that's sort of one way that you might get some liquidity for that. And again, some of that even hinges on, and I'm sure we'll get into this, exchanges and tokenized security exchanges and so forth. Anyway, did I go too deep in the weeds?
No, I we needed to dive into that. So thanks, Dave, for pointing that out. It's I think it's an important thing to know because so many different deals, you know, a big sort of, at least from an investor side, people talk about the what sort of restrictions there are, what kind of holding period there is, vesting, things like that. And then when you know, especially in the crypto space, I remember last year people going like, well, if you don't let people instantly put it on an exchange, no investors are going to come on board. And then the startup would be like, well, if I instantly give liquidity, then people are going to pump and dump our tokens. And regardless of the legal aspect of all these things, that was a key point. And so I think it's important for people to know and understand it, and also know that we're talking about security tokens. It is no longer that Wild West. Like when you talk about a security token, it's not a security token if it's not compliant. That's the whole point. So whether you love these features or these restrictions or not, you still have to deal with them and understand them. So, which is one of the reasons why this is sort of a very perfect panel to put together, right? Because, you know, now I'll make the segue over back to Justin. The whole process, right? When you start working on something like this, you obviously need to get your ducks in a row, and you have to have a legal opinion. You need to have legal representation, which is why Marty's here. And then Justin actually can give you some of the compliance building blocks that make your life significantly easier. Because when you do decide to do public solicitation or not, when you do decide to tokenize or not, there's certain restrictions and certain things you have to comply with. And Netki, you know, you guys build the tools. I know that you discussed it a little at the beginning, but you didn't dive into super specifics on what maybe your most used tools are and what your customers usually use you for, or at least
for sure. Yeah, I'm happy to chat about that just a little bit. And, you know, we usually sit, you know, a little bit downstream of the process from someone like Marty, who's really helping companies make decisions around what structure is appropriate for their offering. And then based on both the structure that they're using as well as who their investors are likely to be, like, are they all domestic US or are they also overseas? You know, if it's a security token offering today, in most cases, if they're US, they're going to be accredited investors, other things like that, that really drive your policy and the decisions that you need to make from there. What we do is we actually build the tools that make that easy to do. So nobody who is issuing a security or, you know, starting a company or raising money wants to have like a side major in building out compliance tools. Because I think, you know, one of the things that I think Marty and Dave would both agree with is that managing your compliance appropriately and building the framework around it can actually be as complex as your core product itself, because it can have a large number of moving parts. If you're operating in multiple jurisdictions or with investors from multiple jurisdictions, it can get even more complicated because you're having to deal with different kinds of identity documents, validation requirements, and different rule sets around what must be done, and things like that. So what we do is we provide tools to make that easy for our customers, to really help automate that customer onboarding process around KYC, AML, and accredited investor validation. So whether a company has investors that are corporations or funds, or whether they're individuals, and then, you know, whether they're domestic or overseas, we're able to help automate that process. So if you think about it for like a corporation or a fund, you know, there's typically a bunch of information that you're going to want to know about that company. What's the company's name, where are its incorporation papers and business licenses, who are its directors, who are the underlying beneficial owners, who owns the company, and who are the signatories that are going to be acting on behalf of it. You'll also probably have additional questions that you want to ask around, like, what's the source of funds, where are the funds coming from, and things like that. So, you know, people will fill out that PDF form, or companies will fill out that PDF form, and then we'll be able to pull information out of that to drive the rest of the compliance checks that need to occur there. Similarly, like for an individual that's going through the process, they'll just pull out their mobile phone, they'll take a photo of the front of their ID, the back of the ID, and a selfie, and we'll be able to take them through like a bank grade onboarding directly from their phone in like 60 seconds. If they need to do accredited investor validation, there's some additional information that they're going to need to submit to do that validation. But then we drive those results back for both the individuals and the corporations into, you know, a single dashboard entry or single API call for our customers going forward.
I think that the average company also maybe were a bit traumatized from the crowdfunding rules or something like that from the years of getting into this stuff. But I think that the average company doesn't realize. There's sort of two parts. So maybe I should start with what you mentioned earlier, that you need to basically, this could be more complicated than your actual product. I think that as we start looking at STOs as an option, I think at the beginning especially, you shouldn't be doing it unless it makes perfect sense for your business and you have some reason why this is a part of your business, right? But as we move on, it might just be a better way to have, you know, shareholder value and liquidity. And what did you say, Justin? Sorry.
Will just be.
It's going to be a better version of the system. It's making things better across the board. So so as that happens, a lot of the companies that are tokenizing will not be technology companies, won't even have the expertise, even if they wanted to do this kind of thing. So for them to even think about compliance is crazy. They should be using service providers who specialize in this. And that's important. I know you wanted to jump in really quick, Dave. What were you saying?
Yeah, so you know, we're missing one other participant probably on this call, and that's a broker dealer or a platform that does crowd fundraising, because almost everything we represent on this call, the things that every issuer or anyone who's raising money in, you know, for a private offering like this would want to use. Yes. You've got to have a good, so let's assume that you're the product. Okay, so it's Alon Industries, which has got a great Crypto Invest Summit. It's a great product and you want to raise money against it. Okay, so you're the first step. Okay, you got to have Alon Industries, Alon and Joseph Industries. And then you've got to go call Marty. Okay, and you got to say, hey, Marty, I got to write up a PPM and some offering documents, etc. Oh, by the way, I want to leave some flexibility for myself later. I might issue a token. Okay. And you go to Marty, you say, I might issue a token. And he writes that into a very, very simple offering document. And then you've got a broker dealer, and that's someone who's not on the call right now. And that broker dealer is going to engage Justin, because Justin has a tight hand in glove relationship with many broker dealers that have thresholds and quality standards that they use to score their investors. And then you would take those investors, you run them through an onboarding process, which uses Netki, and then they end up on a cap table that Vertalo runs, okay, in an integrated offering process with Netki, for example. And then after that, then you think about tokenizing. You consider tokenizing at that point. That's when you have the choice, like, where did my investors come from? Are these the kinds of investors who are going to appreciate or utilize a token? What are my jurisdictions? Do I have to worry? I have to go back to Marty and go, Marty, do we have to do some new paperwork for a different jurisdiction or something? And then what you do is you use the other thing that Marty just talked about, was Rule 144. Rule 144 is the gift to companies that want to tokenize. And I'll explain why. Tokenizing is technically and legally complicated to do. It is not by any way a rubber stamp. It is not something, and I think me, Ben David would agree. I think Carlos Domingo would agree. I think that everyone, my other partners like Securities and Polymath would agree that you cannot push a button and produce a token. So the Rule 144 in restriction is a magical thing, because it gives you up to a year after you issue to write and test, audit, and then list a security token.
And I think we're in a good timing space too, where you just mentioned 3 different options for tokenization. There's a bunch more. There's companies coming, and I think they're all going to specialize in different things. They're all going to be really good at certain things. Some of them will be good for certain types of companies. Some will be better for other types of companies. And so you're going to have time to figure out how the landscape plays out too. And I think that it's going to be significantly less expensive 6 months from now than it is today also. And I think you're absolutely right. That sort of going back to that first statement, that changing the way we look at tokenizing, right? You shouldn't lead. I think that the companies that lead with we're tokenizing our company or we're tokenizing our deal are totally backwards, because an investor really doesn't give a crap about that first. What they care about first is this a good deal that I'm investing in? And so I love that. I just want to also just point out and go half a step back to what we were talking about with Justin and the compliance side, is that the one thing people don't realize is just like Dave said, it's not just pushing a button, right? And just like it's not as simple as pushing a button, just because products like Justin's exist, you might think like, wow, that's overkill, you know, like I don't need to do all that stuff. I know Dave, he's gonna invest in my company and it's done. But what you don't realize with the way the rules changed in crowdfunding, where I was getting at before, is that the liability for verifying that information falls now on the company who's raising the money. It used to be that if I would, before public solicitation was allowed, which was the rule that made it so that you can post on Facebook, my company's raising money, or post on Twitter, we're raising money for our company. Before that, you would give a piece of paper, Dave, will you invest in my company? Yes, I'm putting in $25,000. I initial next to a box that says I am wealthy enough as an accredited investor to lose all this money, and I understand that I might lose all this money. They sign the docs, they give it to me, and if I lose the money, I lose the money. Now, if that same process happens, but I publicly solicited and I never verified with a third party or with a lawyer or an accountant that Dave was an accredited investor, and he came back and said, actually, I lied, I wasn't an accredited investor, you're legally obligated to give them their money back and you can get in serious trouble. That didn't exist before. And I think that people don't understand that fully. And that's why they kind of discount some of these ideas, partly because we're part of this crypto world. And it's like, oh, screw that. I want to be able to click on the internet and invest. That's just, this now exists. So you have to take this stuff and look at it out of that lens too. It's not only important from a general standpoint, you don't want to be using terrorism money to launch a company, but it's also important to cover your own ass. You want to do this right. And you want to use the right service providers, people like Netki, people like Vertalo, reputable lawyers like Marty. So you just got to be careful. There's so many people in this industry that are like, oh, I've got a one-stop solution. I'm going to click a button. You're going to have a tokenized fund. It never works that easy.
Well, and a comment on that from my perspective is, even if you're using someone like us, you still need to be involved in the process because, as Alon said earlier, you actually still own the risk if something goes wrong. No matter who your service provider is, what they can't do is offset your liability, particularly your criminal liability around KYC and AML. And, one of the things that I can see definitely from the view that we have in the industry and the ecosystem is, the people that have weaker KYC policies or who aren't paying attention or things like that, end up not just being, victims of bad guys hiding money and moving it through their service, but that's also the window that people use for fraud. Because if someone's a fraudster and they're going to attempt to defraud you in some way or do something bad to you, they don't want you to know who they are. Yeah. And so, if you have a policy where you're not really checking out, who your investors are, who your customers are, you're more likely to have bad people gravitate to your service because they're looking for those places where they can hide who they are so that they can do the bad behavior that they have. And so, all of us are building projects because we want to build good things. And, you know, we want to be able to put good things out there. And, you know, what we never want to have anybody do is have to feel like after they've done a fundraise that they need to look over their shoulder and spend their time worrying about what law enforcement or compliance is going to think about what they did, rather than being able to focus on, you know, using the money that they raised on building their business and doing the things that they really wanted to focus on building on. And so, you know, we sort of sit in the middle of the process, right? We're not the first thing that you do, but we definitely are pretty early in the process. I would just say, you know, what we've seen is that the customers who invest the time in really understanding what's going on there and how it's going to integrate into their overall flow and process and other things tend to have the best and most successful experience.
I mean, it makes sense. Marty, I think you're muted again.
Sorry. You know, I want to reiterate what Justin said and the importance. I really appreciate the groups like Justin that provide that service. I think it's extremely valuable. And as an attorney advising clients, it's an interesting thing because we get asked all the time, okay, well, we've got to do KYC, AML, we've got this process. And like you said, you see a lot of people trying to shortcut that. And where it becomes really difficult is where you have, you know, I think it's easier when you're talking about it sort of hypothetically. But recently I had a client that they had this deal and it was large transaction in the crypto space, and they were trying to rush through, and we were having a really hard time with the KYC and AML and getting that information. But you know, you see dollar signs there and you see this ability to make money, and it's really hard as an attorney trying to tell them, you guys got to slow down. We need information. So and they had used a third party, probably, in fact, I will say it wasn't somebody as reputable as Netki. They'd used somebody who provided this report. I looked at it and said, this isn't going to work. They said, well, come on, you know, the liability will fall on them. And I said, it won't. So it really is it's an important part of the process that I can't stress enough. And so I just wanted to back what Justin was saying.
Yeah, I mean, the whole point of technology, right? The thing that drives me nuts with most of this verification is one, you know, there's certain sort of ethically big overarching, you know, passionate things that I have, and most of the people listening or watching know my feelings on all this stuff. But there's also the fact that, like, there is now the ability, at least with things like Netki and with using technology, to speed up the process. And I do, you know, when there's certain things that slow down the process, that is crazy to me, right? Like if I think about selling things on the internet, I worked at Amazon back in the day. And one of the things that literally, like that report, I don't know if you guys remember, maybe 4, 5, 6 years ago, there was some report that Amazon put on that explained, it's partly a sales thing, right? Because they're talking about selling AWS to everyone, but they literally had a report that showed for every millisecond of load time a page took to load on Amazon, it equaled a certain amount of revenue, right? And we all know when it comes to funnels and selling things on the internet, every single step and hurdle in the process equals drop off. And so selling something, whether it's a product or an investment opportunity on the internet, you want to be as frictionless as possible. So, but you also need to walk that fine line and not do things in a way that will get you in trouble, because this is serious trouble. This isn't, we're not goofing around. So when we talked about broker dealers for a second, Dave brought it up. Marty, I mean, maybe Dave too. Do you guys know when it does come to the liability of things? I think having a broker dealer in the process could actually put some or most of the liability on them, and sometimes maybe even the legal process. If you have lawyers sign off on certain things, it takes some things off of your shoulders. Is that true, or am I wishful thinking?
So I think there, okay, I'm gonna make sure I'm unmuted, good. I think there's truth to that, but I think you have to weigh that with your previous statement, with that friction. I think broker dealers can provide a very beneficial service. They can shield some of that liability, but that comes at a cost. It comes at an economic cost, but it also comes at a friction cost. I've worked on deals with broker dealers and, really great broker dealers, but the, I talk about how careful I am as an attorney, but they really, because there is a lot of liability that will fall on them, they can grind things to, I don't want to say to a halt, but to a very slow drip. So,
and I guess it also depends on what their role, right? Because some broker dealers are actually, tied to bankers and things like that, and they're actually helping on the fundraising side, and they obviously want to raise as much money as possible. It's part of what they take fees for. So I'm assuming they don't want it to grind to a halt. They want to protect themselves, but they also want to raise as much as possible, right?
Dave, I'd be interested to get your take on that and your experience in working with broker dealers in that space.
Well, I'll say in full disclosure that Vertalo loves broker dealers. We develop technology that can be white labeled by broker dealers because we think that in this new kind of security token or digital securities offering world that we're entering, that broker dealers are an essential player in this ecosystem. An issuer might be great at developing product, but they're not great at, for example, qualifying their own investors. That's why you use someone like Netki. They're not great lawyers. That's why they use you, Marty. And they're not necessarily great fundraisers, and they don't have great connections to sources of capital. Okay, so broker dealers are essential. The other thing that brokers dealers have is they have processes and they have standards. And those things are honed over time, and they can be very, very helpful. When this revolution picks up speed, it's going to be because some enlightened broker dealers are out there spreading the word and saying tokenization will bring liquidity faster at a lower discount. Okay, and that you should invest in these offerings because you'll have something that you don't have in most private offerings, a better chance at liquidity. And a broker dealer is going to be able to do that, sell that message. And then the other thing is broker dealers will likely be pioneers in the use of ATSs and employing ATSs for the secondary trading and secondary liquidity for many of the early offerings in the digital securities space. So I think that, like anybody, there's the peanut butter is not spread evenly over the bread in terms of quality. But you find the right broker dealer for the right sector that's got the right processes, they're going to be a big help, much more so than a hindrance, I think.
And I think that it also goes to one, there's two things, and I think we mentioned it on previous shows here, is that a majority of funds raised. So we're a bit in this bubble of the tech startup world for the most part. And we think of the CEO of the company, he's in charge of fundraising. That's how it goes. Like the Mark Zuckerberg type kid comes into an office, tells a VC, I'm raising $1 billion for my company, and they write him a check, and that's how it works. But a majority of money raised for alternative fundraising deals in this country, whether it's companies or real estate or whatever, are raised by third-party marketers. And when I say third-party marketers, I mean broker dealers and bankers. It's just how it works. Now, if this is if tokenization can be a feature that makes their product even slightly better, that could mean that product sells at a premium. It could mean a 1% premium, it could mean a 5% premium, whatever that is, they want to utilize that. Obviously, they want to have a better product to sell. So it makes perfect sense. I wanted to quickly segue, because we are getting close to time. We've been talking about mostly deals and companies that raise money from accredited investors. we didn't really totally talk about, I think that actually all three of your products will be very exciting and very useful for the world when we start opening up more to unaccredited investors, when there could be thousands of people on a cap table, when there is thousands of people's information to process or millions of people's information to process to do a certain deal. So far as I know, there hasn't been one approved Regulation A+ deal. That's basically the light version of going public, which allows people to raise up to $50 million. I think Marty can clarify the specific rules, but up to $50 million from people who aren't already millionaires. But people are using Reg CF, and I think that's, and Marty can clarify too, that's because Reg CF process is that you just have to file paperwork and then you can do it. You don't need the prior approval to start doing it. So, but how do you guys feel all of your products will change over time, or how will it work as that becomes legal and available?
I'll go first. So I've been one of the people that's been evangelizing Reg A+ and the possibility that is sort of being the golden goose or the key to this sort of the tokenized security revolution. But as Alon has said, there hasn't been any approved. I have several that are with the SEC now and have been there for a long time. There's a bunch of us attorneys that lament about being close, but nothing's happened. And I think that it's going to be sort of a 1-2 where I think the SEC is looking at it, not only the initial offering, but the secondary market for that. And that goes with what Dave was saying about ATS, these alternative trading systems. And I know there's several applications with the SEC in that field. I have a few of them that are there as well. So I think that once that levy breaks and things start flowing, I think we will see, I really think it'll be revolutionary. But until that time, we're in sort of this waiting period. Like you said, there's been some action on the Reg CF side, but you're limited in the amount you can raise. The investors are limited in how much they can invest. There isn't a secondary market that's ready. You're buying restricted securities. So it's not ideal. But I think that hopefully soon we'll see movement there.
Yeah, and then just to go one step beyond you're selling restricted securities and there isn't the secondary market. I know that they're in the crowdfunding world, not tokenized stuff. Reg A+ deals have gone from raising money to on NASDAQ, like in as short as like a week or 10 days, which is really, really cool. So Justin, on the unaccredited investors side, you guys,
we're ready to rock and roll.
You're ready to rock and roll?
Yeah,
love it.
we do. We actually designed our service from day one to handle massive scale, and so we've already had production loads go through our system of thousands of validations in a single hour, and so bring on the CF.
Love it. And then Dave, and your software, I'm assuming as well.
Our software scales to whatever you can stuff a lot of Reg A+ small investors into our software. Here's our POV on Reg A+. I love the use of Reg A+ to bring secondary liquidity to venture funded startups. Venture funded startups, the goalposts keep on moving further out. A lot of smaller investors can't get in these deals. Imagine Uber, imagine Lyft, imagine all these other companies. Some of those employees and early investors, et cetera, being able to sell some of their holdings in a tokenized offering to anybody. Okay, I think that's Reg A+, like right there. And Vertalo, one of my main goal for this company, besides building cap tables, is really my mission is to bring secondary liquidity to venture funded investments, so that founders like myself, early employees, early investors can get out before 9 or 11 years. Reg Reg 8 Plus actually is really boring to a lot of people, but to me, it can unlock latent capital and talent to create new entrepreneurs and new companies if it's applied to these kind of frozen venture funded assets. I mean, 50 million bucks. Why not? Why not use that for secondary liquidity for startups? I think why not?
Yeah, I love it. So with that, I think we could go on a lot longer, but I'd like to have everyone really quickly before we sign off, give us where to find them, the URL for their websites, etc. Let's start with Dave again, really quick. Dave.
Yeah, hi everyone. Dave Hendricks from Vertalo. www.vertalo.com. Come to Vertalo for the most comprehensive map of the security token ecosystem. And hope to see you at Crypto Invest Summit and Security Token Summit in April of 2019.
Yes, yes. I will also clarify that all three of these guys will be joining us for Security Token Summit, and I've been a part of CIS in the past, and I really appreciate them being a part of it. Justin, where do we find you and Netki?
Absolutely. So you can find us online at www.netki.com. You can email me there at justin@netki.com. Or you can find me on Twitter at Justin, the letter W, Newton, all one word, Justin W. Newton. Thanks.
Love it. And Marty?
Yeah, you can find us at clilaw.com, or on Twitter, I'm at Marty Tate. So yeah, and I'll be at CIS, so looking forward to seeing you all there.
Love it. And then what I'm going to throw back, I wanted to say something and then I got sidetracked in my own head when Dave was saying the industry map on Vertalo's website. If you should go check it out. It's a really cool landscape of the whole industry. It breaks it off into sections. And if you saw our research report that's on digitalsecuritiesreport.io, I think, off the top of my head, you saw parts of his graph on each one of those slides, and you've seen it places. The second you see it, you'll be like, oh, I've seen this pasted in Telegram rooms or on Twitter or wherever. They did that, and their newsletter is really great for the industry. So make sure you connect with all of us on LinkedIn as well, and thank you so much for joining us.
Catch you all soon. Thanks, everyone.
Thanks, everyone.